Welcome viewers and investors to the Outlook Money webinar series. This is part of the Investor Education and Awareness Initiative of Aditya Birla Sun Life Mutual Fund in association with Outlook Money. I am Nidhi Sinha, editor Outlook Money, and today our topic of discussion is financial freedom, retiring rich. So before we start discussing the topic, let me first introduce our panelists for today, who will join us for this discussion. So first of all, I would like to welcome Mr. K.S. Rao, who's Head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC. Mr. Rao's top priority is to take financial literacy and investor education to various demographic segments across geographies. And he's been working in this area and in the mutual fund space for the past 2 decades. We also have with us Mr. Amit Trivedi, who is an author, speaker, blogger, and trainer, and has more than 2 decades of experience in the capital markets. He has authored a number of books such as Riding the Roller Coaster and Money-Wise Perspectives for Women. We also have with us today Mr. Roongta, who is a personal finance and tax expert and writes for various media organizations very regularly. He is the founder director of ARIA, and he's been part of the retail lending industry for a very long time and has penned a book on home loans as well. Lastly, I would like to introduce you to Mr. P.V. Subramanyam, who's many things rolled into one. So he is a chartered accountant by profession and also a trainer, educator, and author. He loves number crunching. That is something very important for the personal finance domain. And for about 20 years or so, he has been piecing together these numbers into stories and spreading knowledge. So welcome to this webinar series, gentlemen. Coming to the topic of discussion today, which is financial freedom, retiring rich. Now, financial freedom has many avatars and can mean different things to different people. However, for a lot of people, it is about retiring rich, whether you do it at an earlier stage or whether you do it at the proper age of 58 or 60 plus, whatever your sector allows you. So this could, of course, mean, a lot of people would like to hang their boots in style at the right age. But recently, we've seen a lot of people who've been vying for early retirement, say in their 40s or in the early 50s or late 40s, things like that. But to do either, as I understand, is that you need to be well organized and planned throughout your working lives. So today we'll explore this topic in more detail, and our experts will give their valuable insights on the topic. So to start the discussion today, I'll start with a very general question, which is, what is financial freedom? And really, we can start with anyone. Mr. Rao, you could take this question, and anybody else who would like to tackle this question.
Thank you so much. Good morning, Nidhi, and I'm glad to be part of this elite panel. I mean, all of them who are around me has accomplished the financial freedom. Then they are the moving examples. Probably to ask what is the financial freedom, all the 3 of them who have accomplished the financial freedom there. And thanks to our entire Outlook Money for this opportunity for us to speak to audience month after month. And this is very special episode as we look at day after we celebrate 75th year of financial independence, Azadi Ki Amrit Mahotsav, and this is the time to think our own financial freedom. As you rightly put, Nidhi, financial freedom is different things to the different people, but the common denominator could be the same. How you start your journey, the precursor is to have your financial planning, then work towards it. And once you do that right, one individual is the architect of his or her own financial freedom. And it is all that I call is we all look at the country's GDP. That is a go. But not the gross domestic product. But you need to look at your own GDP. You accomplish your financial freedom. That is, you work for your goals and you accomplish your dreams, and you have the plans which you can fulfill for yourself and nothing to bother about money. Then you accomplished your financial freedom. And I look at it as it's a marathon in the life. Financial freedom. I can't keep it as a destiny, and the destiny keeps changing. Moving targets will change. And for me, the beginning days when I started career, I would have looked at X quantum of number as financial freedom. But after reading Subra's book, Retiring Rich, and I always look at, when it started with the 40 rupees, now he says 80 rupees, then, it's all with that, in terms of dollar and rupee, how it is changing. And I need to look at very differently. And
Sure, Mr. Trivedi, would you like to add anything?
So, according to me, freedom means freedom to choose and choosing the life that you want to live. Now, in order to live life in current times, I mean, last few centuries, in fact, you need money to have a comfortable life if you're living in a civilized society. And that's where financial freedom is all about having enough money to be able to live a life of your choice.
Right.
Which also means that while you may want to work, but you would do work of your choice and you need not work to earn money. The money becomes just a byproduct. It's available, it's important, but you are not forced to do certain things because you do not have enough money. That's my definition of financial freedom.
Mr. Subramanyam, would you like to add, especially with perspective from your book on retiring rich?
See, end of most conversations, we keep saying, sorry, it was a pleasure doing business with you. Right? When you are on your own, you can decide whether to say that at all, whether you want to work with that person, how long you want to work with that person, with which kind of people you want to work, what topics you want to work. For me, I keep saying talking about money to me is my ikigai. So talking about equity, talking about financial freedom, I don't look at it as a job. So I keep saying it's 365 days of vacation. Sometime in Bombay, sometime in Chennai, sometime in Kodaikanal. So you choose where you want to be, you choose with whom you work, how much you work, what topics you want to work on, what things you want to do. So when you have all that, so I always measure freedom of people by saying how much time do they have for themselves rather than being, a slave of the watch and slave of the calendar. So if you can remove the slavery of the watch and slavery of the calendar, you're financially free. And that's good enough as financial freedom goes.
Mr. Roongta, your last word on this general question, and then we launch into the real discussion.
So to me, the freedom comes from defining retirement properly. I think whenever people talk of retiring early, what they really mean is that it's not that they're going to sit at home and read newspapers.
Right.
They want to do something, but they don't necessarily want to do it for money. And the freedom to be able to do that, I think that is early retirement. If you define early retirement like that, and you do your calculations, and which is where your advisor and planner comes in, frequently, like when we work with our clients, frequently we find that if you define it like this, that even when you are retiring, you are still earning some money, but you are earning that money doing what you want to do, not necessarily what you are currently doing. Moment you define it like that, then the amount of money that you need reduces substantially. And when you do the calculations, in many cases, we have found clients who found out that they already have that much money. Okay. And this free yourself fund, the FY fund, having that feeling is exhilarating. I've seen it in faces of clients. It's very exhilarating. Or even when you are nearing that goal, it is so exhilarating simply because it frees you from having to do something that you don't do for money. And the surprising thing is, some of those clients go back and do exactly the same thing that they've been doing. But now they're doing it without the pressure. And I think they enjoy more and they're more productive.
Right. So yeah, I think freedom really, like all of you highlighted, it's about having that time to yourself and, to be able to spend your time the way you want to and to do what you want to in life and not just be a money machine where you're making money. So, but still, we see a lot of youngsters also getting into this concept. As in, like Mr. Roongta said, I'm sure a lot of people in the late 40s or early 40s perhaps already have that purpose, but they don't realize it, that how their needs will go down, etc. But what is the right time to retire? And retiring rich is a concept that everyone loves and hopes for, but when is that possibility real? I'll put this question to you, Mr. Rao.
Thanks, Nidhi. And in fact, a lot of insights from each of them. And apart from that, I would like to add here your latest issue of OLM. I mean, the way you have written about small freedoms and the entire article, I loved it. Probably that gives an audience a perspective beyond what we speak in this next 35 or 40 minutes. I request audience to go through the Outlook Money issue of the current month, which is focused on the freedom. It's
Thank
covered
you
so
so
well.
much. Thank you so much. So what we basically focused on that, these a lot of these youngsters in their 30s, perhaps, they think of financial freedom, but they don't realize that, they would need a substantial sum of money or substantial planning to be able to do that. But, of course, that doesn't mean you stop yourself. So here are some small freedoms that, we have tried to talk about that can give you that sense of ease. So thank you so much, Mr. Rao, for that feedback.
Thanks. Yeah, coming back to the question, it's retiring rich is a wonderful concept. I mean, it's like, everyone will dream for it. Everyone would like to accomplish. But how many of us will really do it at the end? I'm not very sure. I'm not having any statistics at Indian context, but global context, it is, there are some surveys which I've done. And some of the fund houses like PGIM has done some survey, and HSBC Insurance has done some survey. If I look at these surveys shows only 1% at the end of the 100 people they accomplished true financial freedom. Means, and many of 65% of the people still they continue to paycheck even at the age of 60. Means this concept is good, but if you are not acting to the concept, then it will not work for you. Then I'll quote one good interesting anecdote from Subrasa's book, Retire Rich. And he says, even it's like a cup of coffee in Starbucks today is sufficient for you to save. And that can create a financial freedom provided you plan and provided you stick to the discipline. Probably later you will share narrate about his entire story on that book, what is done. And I look at if somebody has to start, whichever the age you are, start today. Whether you are at 20, you are looking at a financial freedom, this is a day. If you are at 50, then this is a day you can start. I in our coaching journey, we follow this concept called grow. I mean, while we are coaching our clients, we put this framework called grow, GROW. This is an acronym, and similarly, the financial freedom, if you can keep that concept, if you bring it here, what is your goal is to get the financial independence, that number, that maths, right? G stands for your goals. I mean, what is your goal? Retiring at what age, what kind of amount you need, and you need to get that back end calculations. It is not the money what I need, but the money is sufficient for me to the period I am going to live, which is meeting my inflation and taking care of interest. We look at only one ROI in the world. It is on written on on my income rate. And sometimes it is not that ROI can be your rate of inflation, that ROI can be your rate of interest, in the current rates and in the future rate, which is applicable. And that is also that ROI can be regularity of income you look at. Then you can work on with that goal and that ROI. Then once that goal is formed, the second, the R in that concept we talk about is it is about the reality, where you are standing now from your journey, where you want to reach, where you are standing. Then you can plan your investment accordingly. Good financial planner can always be assisting you. Whether you are at 20, then you have 30 years to go, or 20 years to go, then you can have your plan accordingly. You can have that grow concept, the R. Then O is an option. Sometimes, which journey you want to take, basing on my risk profile, basing on my current income, basing on what I intend. There could be options. I can go simple mutual fund SIP route, or I can take some other route. What kind of options you can look at when you want to go for your goal post of financial freedom. Last is the W. We coach our clients. What is that you are willing to do? What is your way forward? Willing is this is where most of the people will plan. They have a plan. They understand there's a plan is long way to go, and they know there are options. But what they are not willing to do is either you are delayed gratification, or start investing now, or giving earmarking some kitty for today to ensure tomorrow. This is where you have a gap, and this is a true gap for us. For us, retirement is we call it the golden age plan, GAP. But true gap comes is your action plan, where you don't want to commit. At the 20, you tell someone, oh, it is 30 years for me to go. Why should I save now? And somebody you go at 50, you say, oh, I'm too late now. I can't accomplish what I want to accomplish. Because if I sit with my financial planner and I get those numbers, I look at, I'll never accomplish it. Then you need to plan that in a way, put it under those simple framework, GROW. What is your goal and what is the reality, what options, and focus on your W, how much you want to save and how you save, what options you have. Then that is where you can get into your goal of financial freedom. It is not the time where you are in. Time is today, time is now, not tomorrow.
Right, right. So, of course, the first step is goal setting. Unless you work towards that goal, it's pretty impossible to reach a goal if you don't have one. So, so once you have that goal, so Mr. Roongta, like you handle a lot of clients in the advisory space and all. So, what are your tips? What are the tips that you'll give your clients to if they want to achieve this goal of retiring rich?
So, I think. Two important things. I mean, retiring by itself cannot be looked at in isolation because, you would have several other goals and, there always are trade-off. Any decisions you take, there is a trade-off. Okay. So I think unless you look at your entire plan, you will never feel assured that you are well on your way to, financial freedom or to be able to retire, meaning to be able to do what you really want to do. That's, right. I think, one. A second important thing, okay, and slight differentiation I would like to bring in. I think this delayed gratification is a little overdone. Okay, I think enjoying the journey is as important as reaching the destination. Okay, and I think making a plan to make sure that you enjoy the journey, okay, is very important. Probably, I have not read the articles, probably the small freedoms that you have mentioned. Okay, and I mean, and frequently we find when you work with clients that, their initial expectation is that, when you go to an advisor, he will say, don't spend anything now, keep everything for retirement and, then बुढ़ापा अच्छे से गुजरेगा. Okay. लेकिन if I don't spend now, or let me put it in Hindi because it comes across much better in Hindi, कि मैं अभी पैसा नहीं खर्चा करूंगा तो मैं अभी बूढ़ा हो जाऊंगा. मतलब when will I enjoy my money? Again, when you do it as per a plan, even these small enjoyments, if you put it as a part of your plan, okay, be it a small little holiday, be it something that you buy for yourself, okay, be it a small little thing that you do for your hobby, etc. Frequently, they are so small, and yet the level of enjoyment that they will give you, and they charge you up for reaching the destination, it is worth it. You are able to enjoy it provided it is part of the plan. So I think both the things are important. You cannot look at retirement in isolation. You have to look at other goals that you would have, because only then you feel assured that you are doing whatever you are responsible for. And it is equally important to enjoy the journey towards each of those goals.
That's a very interesting perspective, and I totally agree with it, because, I personally think that a lot of times goal-based planning, it gets delayed, or, people don't follow it to the book because they feel that, in the journey, in the process, there will be a lot of sacrifices. So, of course, that's a very interesting perspective, that there has to be a balance in your overall life on how you kind of look at your life and how you want to lead it. But coming back to the retiring rich concept also, it is, for most people, it is a long-term goal. And we know that equities have a role to play when it comes to long-term investing and long-term goals. So, Mr. Trivedi, how do you think equities can play that role? And, what is the mix of equities that should be part of a portfolio when the goal is really retiring rich?
So, I'll pick up from what both Rao sir and Harsher mentioned. Harsher talked about, enjoying that journey, spelling the rose along the way. And somewhere you use the word, people feel that there is a sacrifice, that you are not enjoying now and you are saving for future. But what Rao sir mentioned in that grow model, that W is the willingness.
Yeah.
Now, instead of trade-off or sacrifice, if I say, what are you willing to do? Then I'm giving a positive twist to the whole thing. And that willingness is where, if I have to, achieve my retirement goal or achieve my financial freedom goal, let me not use the word retirement, but achieve my financial freedom, then I should be willing to do something today so that I can get the results tomorrow. Now, interestingly, equity is an asset class which is risky. Everybody knows about the fact that it is risky, but people miss out on one particular part. So what is risk of equity? That you may not get the desired results. You may not get desired returns. But in order to beat inflation over a period of time, because if you want to be financially free, you have to maintain your cost of living, and that cost of living should be funded through a corpus. In order to beat that inflation, you've got to get into an asset which has the potential to beat the inflation in spite of the risk. Because if you don't get there, then there is a guarantee that you will not beat inflation and you will never be financially free. I mean,
right.
As somebody has very popularly said, I'm yet to meet somebody who became rich only by putting money in savings account. It doesn't happen that way. I mean, when I put my money in savings account, only the bank gets rich.
Yeah.
I don't get rich. So if that's the case, in spite of the fear of equity, I don't see any other alternative. That's point number one. Point number two, when you invest in equity, now understand the risk involved. If there is a risk, then let's understand the risk involved. The risk involved is the businesses may shut down in whose stocks you bought. The stock prices may go up and down. And these two can be handled beautifully by investing in a diversified portfolio of good quality companies. And it is important to remember here that diversification is a second step. Good quality companies is the first step, because if you invest in junk stocks, you get a bigger garbage, nothing else. So start with high quality and then diversify. And for that, once you've done that, the individual companies or individual businesses getting impacted, that risk comes down. Then you are only left at the mercy of the so-called market risk or the volatility that we talk about. This volatility can be countered through multiple ways. One is stay invested for long term, and number two, keep investing regularly and enjoy the benefit of rupee cost averaging. As we all talk about SIPs, systematic investment plan. Now, this is where people worry too much about the volatility of equity, but don't focus too much on the volatility of their investment behavior. Am I consistent in my monthly investment strategy, which is SIP, or am I erratic there? I think that standard deviation is far more dangerous than the standard deviation of equity portfolio. If you do that, so again, just to quickly summarize, you can't avoid equity if you want financial freedom over a long period. Number two, the way to reduce risk of equity portfolios, and reduce only, not eliminate, reduce, is to invest in a diversified portfolio of high quality stocks. For that, anyway, mutual funds are available, and then the market volatility can be addressed through remaining invested over a long period of time and regularly investing in a consistent manner. Once you do that, then financial freedom is yours to take.
So that we were talking from the long-term perspective. So again, I'll come back to that, that whole issue of a lot of people looking for early retirement. That concept became very popular by the name of FIRE in the last couple of years. So coming to you, Mr. Subramanyam, you have dealt with an entire book on retirement. And so this concept of FIRE has been in vogue for quite some time, not just in India. In fact, it started abroad and then it came to India also. So who is early retirement meant for?
See, that is very difficult. I can't be judgmental saying who should financially retire and who should not. But one of the simplest things about financial freedom is In fact, one of the basic things about financial freedom is the greatest financial strategy is when you learn to spend less than what you earn. And that's not very common, right? Even though you think it's obvious, but it's not very common. And the second best thing that you can do is marry a person who also thinks like that. If you don't do these two things, there is no retirement. You're going to work for the rest of your life. So the question is, how do you look at life and what do you, I mean, I would never use the words like sacrifice and things like that when I plan for my retirement. I want it. There is a question of sacrifice. Only because I want it, I'm doing it. Largely, you find people doing a cut paste. Mr. Mukesh Ambani spent 700 crores on his daughter's wedding, so I want to spend 700 crores. No, they don't think in that term. But when their neighbor spends 2 crores on a daughter's wedding, they try to spend 2 crores on their daughter's wedding. This is not on, right? So financial independence and early retirement, you need to have tremendous ability to handle with the public view of what they think that you do. What kind of car you drive, what kind of house you live, what vacations you take. If all these things bother you, financial independence is not for you. Because a simple example, there's a 45, 50-year-old girl who wanted to financially retire and she needed 1.5 crores for her retirement. She had that 1.5 crores and suddenly her dad got sick with COVID and there was 40 lakhs gone. So suddenly you're put back. So you need to have a corpus and you have to have some kind of a safety net if something like COVID were to happen, right? So not all of us are prepared for retirement and not all of us deserve it. Some people who do not have a hobby. In fact, I keep telling women, if your husband retires, you will have half the money and double the husband, right? So that's also not a great thing. He's going to spend more time at home asking for extra tea or coffee and chewing your brain. So between husband, wife, children, they have to decide what they want to do during the time that is available. You need to make a plan of how you're going to use your day. You visit a gym, maybe you go for a music class, you do something. If you can't plan those things, because I realize that till retirement, people talk about money, and the day they retire and they know they have enough money, then money is the last thing that they talk about. There are other things that they need to do. They need to build up their contact of friends. They need to plan whatever vacation they want to do. And retirement, unfortunately or fortunately, has to be learned. You choose, I mean, like everything else, you learn to keep up relationships. You learn to retire. You learn what you want to do, whom to do, how much to do, whether you want to travel, whether you want to sing, whether you want to be a photographer, right? All those things, you need to put all those things in place at least 5, 6 years before you retire. So if you want to retire at 55, at 45, you start planning for what you want to do. And remember one thing, you do not know how long you will live. You do not know how much money you need for that. So it's a very, very difficult question to answer. So one more thing is it depends on your personality. If a financial planner says you need X amount of money to retire and you are comfortable only with 3x, then you will aim for 3x. You know, I keep saying this. This is like two brothers trying to catch a train. One brother likes to reach at 5 o'clock to catch the 6 o'clock train. The other brother reaches at 6:01, saying train to 8 minutes later hoga hi, and he reaches. So both are comfortable with what they do. So each person has to decide what is their comfort level of retirement, how much money they need, what they will do, etc. And for heaven's sake, it has to be a discussion. You can't just walk into your family and say, "Oh, from tomorrow I'm retired." They may not want you. Right? So let a plan, talk, and then take the decision. Don't you want an early retirement? Your office may want you to retire early, but your house may not want to. Then find what you're going to do usefully at least 8, 10 hours a day.
I just wanted to add to what Subra just said. You know, for all our clients, we have something called Enjoy Life Code. Okay. And we've found that we encourage our clients to think about how they are going to spend the money that is earmarked for Enjoy Life Code. And we have found that the most amount of difficulty that clients have is trying to find out how they are going to spend that money. So this is so busy, you know, accumulating. Okay. And I'm sorry to come back to the same theme about, you know, enjoying the journey. But it's not just about enjoying the journey. you must also enjoy after reaching the destination.
Absolutely, absolutely.
And people are, as Subra said, people are completely unprepared for that. And I think one of the roles that advisors play, okay, is helping clients create a framework, okay, by what they will do once they reach their destination.
So I think that is a very pertinent question. And in fact, Mr. Roongta, I was going to ask you this particular question also on, why is it so important to plan your post-retirement also? And this is especially for these young people who are vying for early retirement. I mean, unless you have a plan of action on what you're going to do later, it's quite possible that within 1 year, or forget about 1 year, maybe in 6 months or 3 months, you would feel that, what have you done to yourself? So unless, and it's not just about money and the concept of retiring, because, the concept of retiring, it just sounds so attractive, especially to working people and especially with today's busy lives. But this whole importance of preparing for what comes later is very important. So that is something that I wanted to ask you in any case, Mr. Roongta, if you have anything else to add on it.
So, I mean, just to add on to what I said, as we tell clients, it looks good in TV advertisements when they show people on the beach with those floral shirts and, doing the Zumbas and things like that. Very few people can do that for a continuous period of time. Okay, so as I think Subra mentioned, okay, you need your real investments apart from your financial investments. Your real investments are the social groups that you are forming, whether it is your familial bonds, whether it is your friends, whether it is the social work that you do, the lives that you touch. And I think increasingly people are finding that is very important, and it becomes much more important once you once you sort of get off the treadmill. And I think planning for getting off the treadmill is as important as getting off the treadmill.
So coming back to investments towards this financial goal, the financial investments that individuals need to do, and a lot of our viewers would be interested in knowing that. So coming to you, Mr. Rao, how can mutual funds play a role in kind of investing for this goal?
Mutual funds can play a vital role in every part of the life. One of those veterans in the industry, Mr. Kurian, I mean, who was the executive trustee for one of the fund houses, later he was MP chairman, and he used to narrate one thing: the mutual funds cannot help only to those two people in the world. One is who is unborn, and second is who is dead and gone. Rest of the people, there is a mutual fund journey in the life. And for the retirement, for financial freedom, mutual funds got the easiest way you can do it. I quote this book, James Clear, Atomic Habits. Anything you want to accomplish, if you want to make that as a habit, to make that a habit, you need to make it simple and make so that then you can accomplish what you want to accomplish. Make it simple and make it obvious. Here comes the mutual fund, and what are the impediments you look at? When I was looking at my grow model earlier, the reality here is people want to accomplish, but they are confused because there are some other shorter goals. If you are not planning for the shorter goals like your emergency fund, as Harsh sir was telling about your enjoyments, it could be your family holiday, or it could be something to spend social life. And if you are planning for that, then your longer term will have a bigger impact. If you are not planning for the shorter term, your longer term impact. And mutual funds here play a vital role. But first, you can complete your shorter term of the stuff. You take care of your basic necessities, your emergency fund, your family holiday, your children. Then you have a longer term to work. You have a retirement goal. Then how you can do is like various way to. Before I start, my SIP could be the way to accomplish my accumulation phase. My accelerating my investments. And once I reach retirement, doesn't mean that one day I retire, there ends my life. And post retirement, I have a lot of life. There is a transition period you need differently. Then post transition period distribution phase you need differently. And here for accumulation phase, I have an SIP or STP. And at a transition phase, I have a various asset classes where I can move my equity to hybrid or to my debt funds. Where wealth creation at one phase, wealth protection at other place, and wealth distribution at third place. And third phase, I can look at my mutual funds, not for a fund per se, but the concept per se. I have a systematic withdrawal plan. And there is a reason I keep saying mutual funds are always your mutual friends. Only you need to understand those 3-4 funds, how it can help work for you. Don't complicate it. And you can get one good advisor around, then it can be helpful to you. I have to start with again. I put for your short-term needs, you complete that with your emergency contingency funds, your liquid funds. And for your equity for the retirement, either it could be a hybrid or it could be a equity funds. And later during the retirement, your monthly withdrawal, you use your SWPs, and still part can be a debt, part can be an equity. And we always use this concept. I think again, I quote Subra sir again, the 3 bucket strategy, which we used to do, talk about how you put into the various buckets. That's where mutual funds can work for you. All that I can say is simplify and make it obvious, make it easier so that you can implement, so that you can't go away. And enjoyment is always like the way Sir says, Sir probably using his name. You need to have that hush, always while you're planning, and you need to make it happy, your happy way. And I agree, Sir, with you. Don't look at your Excel sheets of the return, and no, Excel sheets of the return will make you look good, but you need to excel in the life. That's where you need to be happy.
So, Mr. Subramanyam, could you, tell our viewers about the 3 bucket strategy that Mr. Rao was mentioning is in your book? So, could you, tell us in brief about that?
See, what happens is when you look at your total portfolio, it's very scary during bad markets. So it's easy to put your portfolio into 3 buckets. One is the bucket where you're going to meet your next 5 to 7 years expenses. If your expenses are 5 lakhs per year, 35 lakhs to 37 lakhs should lie in bucket number 1. And it should lie in liquid funds, it should lie in savings bank account, bank fixed deposits, and those kind of things. Maybe ultra short bonds, and then nothing much beyond that. So what happens is when you look at it and you say, you don't feel scared. The second bucket, you could have a little more risk. You could have something about 20-30% equity and the balance in debt fund. That could have another 4-5 years expenses lying there. And the third bucket of equity is mutual fund. And here I'm assuming that you have only equity mutual fund. All are in mutual fund. So everything you have the growth option. So you decide when you want to withdraw, how much you want to withdraw. So after 2-3 years, the market is not doing well. You have withdrawn from your bucket number 1. Remember, you still have 4-5 years expenses, because that, even though you have 6-7 years expenses, that has grown a bit. So you have maybe another 2-3 years expenses left. And that time the market starts resuming. Then you remove money from bucket number 3, which is equity. That is done extremely well. You remove some money and again replace bucket number 1. So you keep using the bucket number 1. And life is comfortable because you keep them also in separate places. So when you see bucket number 1, you're saying that when you look at equity separately, you know there will be fluctuation, but you're saying it doesn't matter. That money is only going to fund my bucket number 1, and bucket number 1 I already have for 5-7 years I have money. So during that period, whenever the market goes up, I remove from bucket number 3 and put it into bucket number 1. So this is, bucketing is more in your mind. Actually, it's your money. You're putting something in this pocket, something in that pocket. Like, I know people who say, I want to put money in a healthcare fund so that in case my medical insurance doesn't pay, I want my my pharma fund to pay for it. It's just a matter of putting different pockets in your head, because that's how your brain operates. So you're just fooling yourself, or you're handling your behavioral finance. You're not getting scared, saying, oh, I had 5 crores, it has become 4.5 crores because of fluctuation. You're saying, okay, I needed 35 lakhs for 7 years expenses, it's not the 32 years. That's fine, because with that time, when the market goes up, I will be able to replenish it. So this bucketing is one, physically you keep it in different places, in different portfolios. And the fact that you know mentally that, oh, this is what I'm going to do, this is how I'm going to do. So it helps you have more peace of mind.
So wrapping up this discussion, last words from all you gentlemen on, key things, maybe one key thing to keep in mind for viewers when they're planning for financial freedom and retiring rich as a concept.
I mean, I would like to, I'll take little time here. I mean,
sure.
This weekend, I was in one spiritual journey. I went to a place, there is a place called, it's like, you have a kund, Surya Kund, it's you need to go and take a dip there. And they say you need to take 3 dips. And that was bringing me back to the financial freedom, which I always say, to get into the freedom, you need to understand this dip, DIP. And I say these 3 dips into 3 dips, DIP, DIP, DIP. The first DIP is, if you want to get a financial freedom, understanding 3 letters, that is your delayed gratification, I is an impact of inflation, P is the power of compounding. And once you understand this first dip, the second dip is you need to get that discipline. And then you to impact of inflation is to replace that I with investing in equity, because you need to get inflation adjusted and more returns on that. And the power of compounding to work, you need to bring it is the P is the persistency. It cannot happen one day at a time. I do it and next day I forget it. You need to do that. And the third one, when you go to the third dip is ensure you have a diversification so that you will never fail. Second is the I is the invest for very long time. It is not that tomorrow morning you can get there. And the last one is all of them said, you build that portfolio. Either it is a three bucket, which one, any portfolio which can give you your gap is not there. Your golden age plan, it can happen with a nice nest egg, which you can create that portfolio. Probably take those three dips. And last, as we celebrate this Independence Day is very unique to all of us. I know there is this message from the Prime Minister, which I like the most, is to celebrate at every house, decorate every house with the flag, Har Ghar Tiranga. Probably from mutual fund side, I can say you start with your Har Ghar sip, and every house can have a sip, and that can be a Har Goal sip. Then you can not only have a sip for enjoyment and sip for your financial freedom. And then it is a truly Azadi Ki Amrit Mahotsav. That Amrit for me is an acronym. You can have A is have your allocation right. M is use your mutual funds. R is understand your risk and rebalance your portfolio. I is always keep investing and investing for the long and for your goals. And the last T is your time horizon of investments is the most important one. Then you can have that truly Amrit Mahotsav and Amrit Kal. Thank you for this opportunity.
That's a holy tip that every investor should take, as Mr. Rao elaborated. So, Mr. Subramanyam, your last words quickly.
So I like Outlook Money and Birla taking retirement to every house. So I think that's very important. If you see 7-8 years of Mr. Narendra Modi, he's not spoken anything about retirement or old age. Because I think the whole country is missing the kind of problems that we are going to have. So I think media, Birla and all of you are doing a great job in taking it to every house. That is a very good thing, because people are underestimating how long we will live. If we live long, so the ability to estimate how long we will live is not there. So create some rules. So you need 30 years expenses if you retire at 60. So for retirement, if you require 10 lakhs a year for your household expenses, 10 lakhs into 30 is 3 crores. Now, when you make that simple formula, obviously it won't work for everybody, but at least in your mind, there is some target to work for. So depending what you said, when should you start investing? You should start investing the day you're born. If you can't do it, your father should have done it. If you didn't do it, you start doing it at 25. You didn't do it at 25, start at 25. Doesn't matter. Just jago, start working towards your retirement, and for heaven's sake, talk about it at home. The worst thing that we do is we don't even talk about it at home. Children do not know how much money we have. And by children, I mean anybody about 13, 14. A 5-year-old may not understand, but a 13-year-old will definitely understand. Sit with them, involve them, because when I've seen cases where an 18-year-old and a 19-year-old didn't know how to handle them. Both the parents were killed in COVID, right? They died in COVID. So communicate within the family. Talk about money. Personal finance is about that. It is not just about where you're investing, but your family know what it is. Talk about all this. Plan your retirement. Make sure that husband and wife think alike. And then go about, then the journey is not very difficult. But if you're thinking very differently, first come to the same page, only then you can start your whole journey for retirement.
Mr. Trivedi, coming to you.
It's an interesting discussion so far, and thank you for the opportunity. Subra was mentioning, kudos to Aditya Birla Sun Life Mutual Fund and Outlook to bring this topic in discussion. It's important that we realize that though we have a very large young population, 30 years down the line, we'll have a large number of retired people. I mean, it's the same population which is going to retire. Sooner we start, the better. And that's where, in the earlier question, I talked about, starting sooner is better. It applies not to just individuals, but to families and the nation also. That's number one. Number two, two popular sayings come to mind, two proverbs come to mind. And we all, use this in the context of discussing certain aspects of life. One is health is wealth, and second is time is money. Incidentally, health is far more important than wealth, and time is far more important than money, especially when one is considering retirement, especially when one is considering early retirement. The healthier you are, you'll be able to enjoy life much better. You would be spending less on medical expenses.
Okay.
And that would add to the kitty as well. I mean, that's a side benefit. And time is much more than money. What you do in retirement is far more important. How you spend your time is far more important than how much money you accumulated in order to retire. So have that plan, put it in order. Sir also mentioned about building that relationships, building that social circle where you are going to spend your time. Identify the activities that you would love to do, and somewhere spirituality comes in, and you would want to contribute to the society, because once you reach a certain stage and achieve that freedom, the freedom must come with responsibility, and with that freedom, the job becomes, can I provide that freedom to more number of people? Can I influence them? Can I guide them to achieve that freedom? That's what I would say as far as sort of closing remarks is concerned. Thank you so much for the opportunity.
Thank you so much. Mr. Roongta, your closing remarks?
So I would just like to sort of end this with why planning for retirement should never be done in isolation. And I'll just give the example of a client who asked me, what's wrong with putting all your and trying to earn the highest possible return from your investments at all time, and as and when the goal comes along, you withdraw from it and pay, right? Now the issue with that, okay, is the fact that when you don't do this trade-off between more important goals and less important goals, right? The trade-off happens because of time. The goal that comes first becomes automatically more important because by that time money is available, right? And by definition, therefore, your retirement typically happens later, whether it is early or whatever it is later. And therefore, whilst you would have provided for other goals, you would not have provided for retirement. So my point is plan, calculate, and do an comprehensive planning that includes all your goals, whether it is to do with your responsibility to your parents, to your children, to your siblings, or any other responsibilities that you would have apart from responsibility to yourself, as well as enjoying the journey. I think when you are planning that, okay, is when you get that sense of freedom that comes from knowing that the probability of reaching all the destinations that you have planned is pretty high.
Thank you so much, gentlemen, and thank you for this vibrant discussion on retirement and financial freedom on India's 75th Independence Day. Thank you to our viewers, and I hope you enjoyed this conversation today. Good day to you.
Good day.
Thank you so much.